Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Jeff Chee, Global Head of Portfolio Strategy at Willis Towers Watson. Morning.
Morning. How are you going?
Very well, thank you. I thought today our conversation would come back to something that's sort of a sacrosanct sort of area in portfolio theory, which is this balanced portfolio, this 60-40 portfolio that is like the reference portfolio that everyone uses. And I wanted to ask you, is this experiment around the balanced fund, over, given where we are in today's markets?
It's a good question. I mean, I don't think that it's over per se, but I think if you think about the last decade, and everyone's kind of done the numbers on this, we've had the best decade for the 60-40 portfolio. The confluence of declining bond yields and the run up in equity markets has meant that people have very comfortably achieved their objectives, holding something like 60-40 invested in a relatively simplistic way. And I think where we are at the moment is that model is just going to be a lot more challenged going forward. And so what I really think people need to be doing at the moment is, I think having that as a reference point is still useful, but then thinking about, how am I going to be able to exploit different levers in order to add value relative to that. And in particular, what paradigm, what framework am I going to use in order to articulate, why would I exploit certain sources of value add? How am I going to allocate risk to those different opportunities? And also, thinking outside the square of, or the binding constraints of a strict asset allocation expressed in the traditional way of X% to a whole lot of asset class, and thinking more holistically in terms of what portfolio do I want to hold at a given point in time. So it's not that I don't think the 60-40 is dead. I think as a construct and concept, it's still useful. But it's more thinking about, from here, it's probably not going to get you to your objectives. So thinking more generally about, how am I going to add value and why, and the justification for that.
So I guess if we use a 60-40 then as this reference of where we want to get to, and we can map that to our objectives, how do you build a portfolio in this type of market where we've got some very overvalued parts of the economy, the equities component, obviously in capital markets, and even question marks around fixed interest. As you look at that backdrop and these being the inputs to the portfolio, how do you feel that you think about SAA and what you want to achieve from an objective point of view, but then take it back to sort of the reality of today, and then how do you map those two together?
Yeah, so I think that the way that I like to think about portfolio construction or portfolio design is, as you say, let's take 60-40. So 60-40, generally speaking, you'll generally map that to kind of a risk target. So you might say, I'm happy in a poor market environment, I'm happy to wear something like 60% of the equity drawdown, and then it's really about trying to compare different investment opportunities. And to your point, there are these overvalued parts of the market. So equities is one that we can point to, particularly with the recent re-run up in equities, pockets of fixed income, et cetera. But trying to think about the different dimensions of portfolio quality that you might want to assess. So you've got your traditional risk and return type dimension. So you can kind of capture that overvaluedness in your return assumptions, in particular for equities and certain overvalued parts of the market. Also on the risk side, we need to think about, are risks elevated at the moment? And also, how are you actually measuring that risk? Is it in a traditional volatility sense, or are we in an environment where we are going to have an elevated probability of these big sharp drawdowns when bad news comes through? Or, I think that the whole COVID has really highlighted that, particularly when markets are sort of at elevated valuations, but even when they're not, there's a wide variety of triggers for drawdowns in equity markets, a lot of which are difficult to anticipate in advance. And so it really just highlights the need to then augment this traditional kind of, risk return mindset with considerations of, the diversity of a portfolio. So just fundamentally, how exposed are you to different things that drive return? Because that's going to be kind of whether you want to call it a risk factor lens, a return driver lens, using that kind of framing can help you to, like two portfolios that have similar risk and return characteristics. One that is just fundamentally less exposed to any one particular driver is going to be more resilient to an unexpected shock coming through markets. And then also, the other kind of lenses of kind of portfolio quality. So whether it be, the liquidity of the portfolio, that's obviously been an important issue lately. Costs matter, complexity, to what extent are you kind of able to, absorb or, kind of deal with uncertainty around kind of assumptions that you're setting. And really, what you can do, a lot of this sounds kind of fluffy and kind of wishy-washy, but you can actually quantify a lot of these things and kind of rank these various characteristics of strategies against each other. And what you can do is then once you've kind of quantified these things, you can actually then say, right, what is my trade-off between liquidity and complexity and costs and diversity? And by doing that, and kind of, whether you want to do it in terms of a balanced scorecard, so we use a construct called a portfolio quality scorecard, where we kind of rank each of these things against each other. I think that is a much better and more holistic way of building a portfolio, because then you can sort of say, equities, for example, if I wanted to underweight equities, what are the other things that I could do? And I can sort of test different configurations of bringing, different strategies into the portfolio and sort of see, if it reduces risk, but it increases my cost base, or it improves diversity, and how happy do I feel about that? And by weighting, those different dimensions of portfolio quality in accordance with, a particular investor's beliefs, you can then better explain how you get there and make sure that the sources of value add and the levers that you pull are, in line with your beliefs, your endowments, your competitive advantage, et cetera.
Let's stick on the risk component, right? And I guess one of the biggest challenges with the overvaluation in a number of parts of the market is that investors feel concerned that they need to take increasing levels of risk to get the sort of return that they used to get. But how do you think about risk in terms of measuring it, trying to forecast the amount of risk that you're taking in the portfolio? How do you factor in sort of this maybe potentially suppressed volatility that we've seen in a number of asset classes, particularly as we've seen sort of Fed support to some of the parts of fixed interest and sort of the support to equities market? If you just sort of look at a historical level of risk, is that really a representative way of risk going forward? How do you guys build that into your portfolios?
Yeah, that's a really good point. And a lot of the traditional models that use historical rolling windows to measure risk will give you sort of, as you say, sort of quite potentially quite misleading answers on the risk side. I mean, I think the first and most obvious thing is to kind of take a long view of risk. So essentially, the risk of an asset class will be a function of the economic regime that you're kind of looking at. And if you did look at the last the period since the GFC, we have had this period of this regime of extreme policy support, and therefore suppressed volatility. But that's just one regime. There have obviously been other regimes where we've had quite elevated volatility. So I think the first thing to do is to sort of think about what are the different regimes that could occur, and what have been the volatility characteristics of asset classes in those regimes, and then recognize that there is a probability that we move out of this current regime of suppressed volatility into one of those other regimes, and therefore you can then directly incorporate that into your asset allocation models or your portfolio construction framework, by sort of saying, right, in this sort of regime, this is the sort of portfolio we want to hold. In this other regime where there's either higher volatility or the increased propensity for kind of spiky left tail events, this is the portfolio I want to hold. And then you need to make a judgment call about how do I then blend these together, whether you use a probabilistic framework or you think about it in terms of portfolio flexibility, like I need to be able to fairly quickly switch from a portfolio that's designed from this environment to this environment, and then that might dimension how much liquidity you need in a portfolio, and so on and so forth.
Mm-hmm. Look, the investors talk all the time about sort of building portfolios with diversification, and the typical portfolios have got equities, bonds, real assets, and so forth. But the reality that we sit in this environment is that some of these assets aren't going to provide the defensive hedge that they used to. And correlations are quickly becoming close to one. And when you get into any sort of crisis environment, if we take it back to the 60-40 or building an SAA. How do we need to maybe rethink this environment, or do we need to rethink this sort of structure that we've got in terms of building an SAA and then sort of building the buckets, or do we need something else?
I think it's a bit of both. I mean, I agree completely that, a lot of the traditional ways of thinking about diversification in a portfolio in terms of, assumes correlations being less than one, and therefore the risk reduction of having these other asset classes in there. You're right. In a crisis environment, you just, that you see the classic, in inverted commas, failure of diversification. And so I think the first thing to do is that it's important to augment any framework that relies on kind of, quantitative assessment of diversification, to kind of do that modeling also, and under a set of downside assumptions, because what that can then tell you is, let's just use equity beta of a portfolio as a very rough and ready measure of the amount of diversification you expect. So let's say a traditional investor is looking for about a 0.5, 0.6 equity beta. That will typically go up to something like 0.7 or 0.8 in a downturn. So first thing to do is just quantify that and understand that, and go think about, in that downside, because the whole reason for having diversification is predicting the downside. Am I happy with that? And if not, then it comes to your second question. It's like, well, what do you need to do differently in order to mitigate or manage the fact that your equity correlation will tend to increase in a downturn? And that is when you can think about, for an Aussie investor, typically foreign exchange will act as a downside risk management tool. So, you sort of tend to see the Aussie acting in the opposite direction to equity markets. So what you could say is, right, if my equity betas or my risk is increasing from A to B, how much foreign exchange do I need in order to at least partly offset or partly mitigate that? Or, duration is another, maybe perhaps not at current yields, but in a more normalized environment, how much duration might I want to have in a portfolio, again, to help to mitigate that downturn? And are there other risk management strategies that I might want to consider? So whether it be long volatility options, noting that those are, long-term, negative carries. So perhaps you don't want to have them strategically, but at least to be aware that they are things that can be added to the toolkit, and understanding at what point in time in the cycle and what sort of conditions might, and think about this in advance, so that then you're ready to kind of act and have these strategies, deployed again in order to try and, manage that decrease in diversification in stressed environment.
Let's stick to the conversation you sort of mentioned about long volatility, right? This is a fascinating one. I've seen it popped up a lot. There's been a few papers around that, the 60-40 moves to this 2020, what a 520 breakup of equity, bonds, real assets, gold, and long volatility. And you've mentioned long volatility. I was curious to get your thoughts on sort of the role that long volatility can potentially play, and your thoughts more broadly in terms of maybe a different structure, moving away from 60-40 to something different, that can survive through different regimes, as you were sort of mentioning as well.
Yeah, I mean, on long volatility, I think that, my personal, my prior is that, long volatility, because the volatility risk premium is positive, long volatility structurally in a portfolio will be, as I mentioned before, negative carry. So it strikes me as something that you don't want to kind of hold. You might not, maybe you don't want to hold in a portfolio from a strategic perspective. Obviously, there are certain investors who are, particularly those who are particularly path dependent, who are close to critical thresholds, who might find that, they're willing to pay away something over the long term in order to have that protection. So my personal view is definitely that long volatility strategies have a place in the broad toolkit, but are unlikely to have a kind of long-term strategic place in a portfolio, unless you are an investor who's, particularly sensitive to tail risk and has a short horizon, so you wouldn't be able to kind of recover. But then coming back to your question around, a different portfolio structure or a different portfolio design, I completely agree that, I think going forward, what's just happened has really highlighted the need to sort of think about portfolios in a much more, how do I build a resilient portfolio that's diversified across a wide range of strategies. And I think not even thinking about it in terms of like, 60-40 or 20-20-20-20, but just thinking about it in terms of what are all the investment opportunities that could sit within what the investment strategies that sit within my opportunity set based on my endowments and my governance, my capabilities, and then kind of assembling them in a way that, maximizes, deals with this equity beta increase that I just talked about, maximizes portfolio quality. And it could be that it comes out at like, 20-20-20-20 for a particular investor who has a set of, beliefs around diversification, has a particular ability to tolerate the illiquidity risk associated with a lot of real asset strategies, the complexity associated with long vol, and so on and so forth. But perhaps for some investors, having gone through that process and having done relevant trade-offs, you could still end up at 60-40. But I think the point is that you've got a properly articulated process that considers all of the things that all of the dimensions of portfolio quality, weights those appropriately, and then gets you to a portfolio rather than 60-40 being the starting point, I guess, is where I would be starting at.
Mm-hmm. I guess in the Australian marketplace, there's an additional challenge, right? And that's almost an unforeseen risk, which is the government risk being early access. So I wanted to sort of ask the question, you sort of talked about tail risk, and I know I've spoken to a number of asset owners who have sort of not being focused on it because they say we're long-term investors, we don't need it, we can afford to ride these pieces out. But when you have a situation where, a crisis results in members switching, either switching out of the fund or switching to cash, or even a government intervention, you could say, where there's the early release, does this mean that tail risk hedging becomes even more critical to the funds?
I mean, it certainly highlights the importance, and not to sort of try and turn the question around to something different. But maybe we'll come back to it. It certainly highlights the importance of liquidity stress testing and making sure that you've got scenarios that incorporate the potential for member switching in a downturn, and now the potential for regulatory change to also trigger outflows from funds. But to get to around tail risk hedging, I don't think it's necessarily around tail risk hedging per se. I mean, obviously, in the environment that we've just had, if you did have reasonable outflows from early release or member switching at the same time assets were depressed, then clearly that's a bad outcome because you're then potentially not able to ride that recovery. So from that perspective, it kind of does highlight that tail risk hedging would have been useful in that sort of situation. But I don't think it highlights that tail risk hedging was any more important than it was before. I think it's reminded people that it was important.
Mm-hmm. Yeah, makes sense. So let's also then dig into the objectives in terms of return. You talked about sort of the process and the inputs that you need to build this portfolio. A number of the funds have been moving to unlisted because of the returns that it generates, but then there's been a lot of questions about the illiquidity issues that come with it and the potential hidden risks that sit behind some of these unlisted assets because they're not being valued on a daily basis, or it's quite delayed. So I guess, how do you think about a lot of the the influence and a lot of the positivity around sort of the unlisted space to deliver returns?
I certainly think that there is definitely a strategic case for having unlisted assets in a portfolio. From a number of perspectives. One, just the diversifying return stream that's associated with real assets compared to corporate assets. That you should, assuming that you've paid an appropriate price for the asset, there should be an illiquidity risk premium associated with buying illiquid assets. But I think the question then comes down to what extent do you want to rely on that in order to achieve your objectives? Because whilst we might talk about real assets being a different return stream to say corporate equity or corporate credit, or the illiquidity risk premium being a return driver, to our previous conversation, they're generally still pro-cyclical, generally still going to have this characteristic of increasing correlation with equities in a downturn, and therefore that should kind of either needs to temper the extent to which you want to go really hard down the illiquids path as a way of diversifying away from equity risk, or at a minimum making sure that you apply, that you're applying a sensible hurdle framework for taking on illiquidity risk. And in particular, and this is something that I don't see very often, that hurdle framework applies an increasing hurdle, an increasing penalty to illiquidity as you add more illiquidity to the portfolio. So, for example, let's say your starting point was 60 listed equities, 40 liquid bonds. The first 1% I put into, say, infrastructure or real estate, probably not much of a hurdle to get that into the portfolio. But once I'm out at, say, 20 or 30% in the liquids, that hurdle, that benchmark should be pretty high.
Mm-hmm. No, makes a lot of sense. I guess that's one of the questions around hurdles. And you talked about the pro-cyclicality of a lot of these asset classes. Does that mean that we now need to start thinking of other sorts of defensive assets or strategies? A lot of work's been done in the alternative space. Is there now a particular pathway for maybe more long short being included into portfolios or something like that, or momentum strategies? How do you think about sort of maybe these alternative pieces as being a better hedge?
Yeah, absolutely. I mean, I think that one thing that we did see, and again, we don't want to sort of harp on Q1 and really major in on that, but we did see that in Q1, a lot of those alternative strategies, particularly if you looked at, say, hedge fund or diversifying strategies portfolios that were designed from a total portfolio perspective, i.e., thinking about what is the purpose of this in the portfolio. It is to diversify equity risk in a crisis. If you built a portfolio appropriately from that perspective, as opposed to just sort of saying, well, I just want a broad mix of hedge funds or alternative betas or quant systematic stuff, those portfolios actually did really quite well in that sort of environment. And also, they're the sorts of strategies that you expect to be positive carry, positive expected return in a normal environment. So, I think the experience of hedge funds in 2008, 2009 really sort of turned a lot of people, a lot of investors in our market away from kind of hedge funds and other liquid diversifying strategies. But I think that we as a house, and I personally have always thought of there as being a strong strategic case for having liquid diversifiers in a portfolio, and continue to think that. So and in particular, as thinking about which slice of those strategies do I want in this portfolio from a total portfolio perspective, recognizing that I don't need to hold the broad range of hedge funds, the broad range of alt betas. What I want is that subset, which is positive long-term expected return, and two is the stuff that's actually going to diversify my portfolio in a downturn.
hmm It's interesting as you were discussing that and these alternatives. Is there merit in creating a portfolio of just strategies? As we think, there's a lot of discussion around building portfolios for people in retirement, and the focus is around sort of capital preservation with this ability to generate income. So I was just curious, when you start to talk about strategies and all these alternatives, could you potentially build a portfolio of say 5 different strategies to create an outcome that preserves capital and potentially can then spin off some income? Let's say it's got momentum, it's got some other value factor, it's got long short. Is that another way to think about portfolio construction?
Absolutely. I mean, I think it kind of links to what I was saying earlier around maximizing portfolio quality and sort of getting away from SAA in terms of being allocating to asset class or asset class buckets. I think the ultimate dream from a portfolio construction perspective would actually be to think about what are the different strategies I put into this portfolio and why, and then to assemble it in that way rather than sort of saying, right, this is a momentum strategy, it must sit in the hedge fund bucket. This is a long short. This is a low vol equity strategy with dividend focus that must sit in the equity bucket. It's to your point. What is the outcome that I want here, and what it is? It's something that I still need. Let's say I still need CPI +3, but I need to protect because of sequencing risk because it's a retiree, and I also need a particular dividend stream. And then when you're assessing the efficacy of adding different strategies into the portfolio, you then test. Does adding this momentum strategy, and what does that do? Right, it helps to mitigate an equity downturn. That gets a tick. This equity strategy, it's yield driven. It's going to be less volatile than just investing in ASX 200 or MSCI or country. That gets a tick, et cetera, et cetera. So I think thinking about it from a strategy perspective rather than an asset class perspective is exactly the way that you can in fact design a portfolio to give you the return distribution profile, or the income payout, or whatever characteristics it is that you want out of it. And then you're not hamstrung by having to say, it doesn't fit in a bucket, therefore I can't have this in the portfolio.
hmm How much do you feel that the whole peer risk, especially in the Australian super fund space, is limiting, I guess, the willingness of funds to sort of think outside the box, to use a common analogy? Is that really the biggest issue as to why we haven't seen much difference? I've looked at a number of portfolios of funds that have even claimed to have a TPA. They've got their total portfolio approach, but when you start to look into it, it doesn't look any different to an SAA. I wanted to get your thoughts on that piece, and also in terms of this whole peer risk issue that maybe is limiting these funds to sort of go out on a limb and try different strategies like we've just talked about.
Yeah, great question, and I think that's absolutely right. I think the just and the whole increasing focus on comparisons, whether it be via league tables or pressure from the regulator and the kind of naming and shaming that's kind of happened recently. All these things are kind of really intensifying the concern that that trustee boards, investment committees, internal investment teams kind of have on peer relative outcomes. And I think absolutely, once you elevate peer risk in the mindset, that can be, it's unavoidable that's going to have an impact on behaviors and portfolio allocation decisions. So I think absolutely the increased focus on peer risk, I think, which is partly self-imposed in terms of you always want to compare yourself to other people who are doing similar things to you. Partly has been imposed by the increased focus of it by the regulator, is absolutely meaning that I think Australian super funds aren't able to innovate or to expand their horizons as widely as possible. That said, I think that if I was going to try and articulate why, if I was running a portfolio, why I would worry about peer risk, I think there is a legitimate argument which kind of runs along the following lines. So the reason why any asset owner kind of exists, so why any superannuation fund exists, is because they have the internal capability, the governance skill to outperform a simpler alternative. So let's say it's 60-40 is kind of the preferred portfolio alternative. And if you legitimately back yourself to have skill and genuinely think that you are improving end saver outcomes by adding value relative to that reference portfolio, what you don't want to happen is for you to underperform and for that end saver to essentially fire you before you're then able to add value over the long term. So from that perspective, I think the peer risk conversation or the business risk conversation, I think can legitimately be thought about in that context. It's about making sure that behavioral issues don't cause end savers to not be able to benefit from the long-term benefits of your investment process and your investment skill, but not comparisons against other people for kind of comparison's sake.
Mm-hmm. So let's continue back on the conversation around portfolio construction, the process, the investment decision making process. What do you see when you talk with clients as being maybe one of the biggest challenges that's out there, or a misstep that funds are thinking about as they go through that process? Is there an ingredient that's missing or something that they could do better?
I think certainly so if I sort of think about the sorts of things that I think could be improved, I think one is just a real over focus on outputs from stochastic asset models and risk return kind of outcomes and things like that. So obviously we need models, and I've spent most of my career messing around with asset models and setting assumptions. And so, but the more you do that, the more you realize that the limitations of using that to inform decision making. And so what we tend to find is that you'll go to an investor or a client with a recommendation around adding a particular strategy to their portfolio. So we think you should add this liquid diversifier to the portfolio, reduce equities by X or whatever it is that you recommend, and the question will come back, show me the modeling outcomes and kind of what it does, and you show the modeling outcomes, and inevitably if it's a kind of 2 or 3% shift, modeling outcomes don't move that much, and the answer comes back, well, why would I do that? And so what I do think, and it comes back to something that's come up a few times in this conversation, is it's that holistic consideration of portfolio quality, and using a balanced scorecard type approach to assess portfolios, I think is something that investors should be doing a lot more of. It's something that, it's most TPA investors do it. It's something that we're sort of starting to see more of, but I think it can be, it should be a lot more widespread, the use of some sort of portfolio quality or balanced scorecard to assess the portfolio, and then to assess different potential portfolio configurations, rather than a really deep granular sort of what's the modeling impact, and does it move the Sharpe ratio around and stuff like that, because that's not the only thing you need to consider. So I think I think that would be my main thing that I would like to see as an enhancement to most investors' processes.
Yeah, the whole conversation about Sharpe, it's something that we learn at university. We're drilled into our head about sort of the efficiency that comes with Sharpe and thinking about risk. Ironically, in the textbook, they talk about sort of normal distributions, and a lot of these stochastic models are based on normals or T distributions that are seen to be pretty stable. But in the reality is that doesn't exist. So it does disturb me that they keep asking for these modeling outcomes. where they know that this is not really going to be the case, or maybe they're ignorant to it. I'm not sure what the answer is, but I guess the concern that then comes is if everybody's using these same modeling solutions, we end up with this peer risk problem, and we end up actually with crowding in trades. So everyone seems to do the same thing. You get this overvaluation, and you see these big pendulums of money just swinging in and swinging out. It's causing more and more problems. Is that how you see it?
I a lot of what you just said absolutely resonates with me. I think that the over reliance on and the sort of almost leaning on the fact that the model will kind of tell you everything that it needs to tell you, and then I'm not sure if so that definitely I see as an issue, and the more use of scenario testing or thinking about even sensitive testing your assumptions at least to kind of deal with the uncertainty, not just around the volatility of the returns and therefore the risk around that, but just the fact that you don't actually know what the mean of volatility distribution is, kind of handling that. I'm not sure if people using the same frameworks is necessarily a thing that is causing crowded trades. I think that is probably more a peer risk thing, which as we just discussed, kind of the rationale for that. But I do think that the use of traditional asset models and the lack of I don't think it's an ignorance thing, but just the lack of interrogation of those outcomes and the understanding of the sensitivity of those outcomes to different assumptions we put in there certainly is causing people to have portfolios that aren't as diverse and aren't as resilient as they should be.
Mm-hmm. It's been a fantastic conversation, Jeff. Thank you very much for your time today.
Not a problem at all. Pleasure.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.